Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My guest today is Scott Brown. If you don't know him, Scott is a fantastic analyst. When I first met him, he was working as a technical strategist over at LPL Financial, but he recently left there to start his own research venture called Beat the Bench. Anyways, I'm really excited to hear his perspective, but before we talk to Scott, it's Friday, the markets are closed, and it sure was a wild week. So let's go take a look at how things played out. Hey guys, thank you for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so all four major indices closed lower on the week by 4% or worse. The Dow was the strongest, but it still fell about 4%. The Russell 2000 was the weakest, dropping more than 6.5%. And while the Dow was the relative leader, there's really nothing bullish about it right now. It closed below those June lows, which is a major problem. And while the S&P 500 managed to close just a hair above those June lows, we're still skating on thin ice here, and this is pretty bearish price action to see heading into the weekend like this. Those June lows are going to be really important to watch next week, not just in the S&P 500, but in the other major indices as well. Could we reclaim them next week? Sure, but caution is warranted as long as some of those indices are below those June lows. Now, let's take a quick look at sector performance. All 11 sectors closed lower by more than 2%. Defensive sectors like utilities and staples led the way, but they still dropped about 2-3%. Energy was the worst performing sector, dropping 10% on the week. Anyways, that's enough from me. Let's welcome Scott onto the show. All right, Scott, welcome to the show, and thanks for joining us today.
Hey, happy to be here. I'm so glad to join you this week. It's been a big week for me, and obviously it's been a big week for markets.
Yeah, it sure has. We got a lot to talk about, so we're going to get right into it. Let's kick it off with the S&P 500. We're recording this about 3 hours before the close on Friday, and you and I are sitting here just checking levels. You know, have we broken that low? But the S&P 500 is basically retesting those June lows. And for the longest time, I've been asking my guests, was what we saw this summer the start of a new bull market or just a bear market rally? And I think it's safe to say this summer was a bear market rally, right?
Yeah, it's clearly becoming that way. Even if today was the exact bottom, we didn't get to 36. I think the kind of panic you feel this week, how close we are in magnitude, I completely agree. This is the retest, and I think that surprised a lot of people. So many people, that stat about 50% retracements from 20% declines. You've never gone back to revisit the lows. Obviously, we aren't quite there officially yet, but pretty violent downturn after a really big rally off the June lows.
Yeah, I mean, all eyes are really on those June lows right now. It's such a crucial level to hold. And of course, we could whipsaw above and below it for a little bit. That would seem to make some sense. But do you think those June lows ultimately hold? I mean, the Dow just broke its June low today.
Yeah, so we registered a ton of really, really extreme oversold readings on June 16th. And since the days following it, my view has been that those lows are somewhere in the ballpark of the lows. I believe that they were kind of that initial thrust. And when we look back at how markets bottom, one of the most classic kind of patterns you see is what's called the bang and whimper pattern. And so it's really actually pretty common for that whimper. It's kind of the bang where you see the most intense selling. And it's actually pretty common for the retest to slightly undercut the lows. So I haven't, been super caught up in does 36 exactly hold, or is that going to be the exact lows? But I've tended to believe that most stocks made their bottom in June. I think that's maybe getting tested a little bit. The S&P 500, we brought some of these charts. The S&P 500 did see a new peak in new lows, and that's kind of an indictment on 36 being the ultimate price low, because usually that happens before the index bottoms. Now, what's interesting on this next chart is we brought the Nasdaq And when the Nasdaq made a new price low in June, actually less stocks bottomed. More stocks made a 52-week low back in May. And so that was really the kind of big thing. This is obviously leads right into the ARC stocks and the IPO stocks and those really just the very worst stocks that have been selling off for 18 months. Those actually didn't make new lows. And so I really believe that we were kind of getting to the beginning of or starting the bottoming process. We'll see, though, if we start to see new low data creep higher and actually break through, I think that thesis kind of becomes null and void, and we've got to revisit, do we have more than just kind of a slight undercut in the cards for the major indexes?
Yeah, I think that scenario, where we undercut the lows and maybe put in a false breakdown is a very real possibility. And it would make sense, right? I mean, I just mentioned all eyes are on those June lows, and sometimes when everybody's watching a level and expecting it to play out a certain way, the market loves to embarrass the masses. Is that right?
I think that's 100% it. And, we still haven't seen, I think we've got these charts later, but some of the, real capitulation that you tend to see in market bottoms. I think you mentioned that we finally registered an oversold reading, which is kind of remarkable that we haven't done that on the index level. But we brought the chart of the VIX, and it's the short part of the VIX curve, the spot price minus the 3-month thing. And I think this is something that was really missing and kind of curiously absent from the big sell-off in June. People talked about the VIX not spiking to 40. This is, again, the spot price minus the 3-month. If you think about what we're looking at here, the VIX curve should be upward sloping because there's more uncertainty in the future. And so it really should be there in negative territory. But it's pretty common in severe sell-offs to invert a little bit, or really anytime in the past 15 years we've had a major bottom, we've gotten this to about a 10, spot VIX being 10 points higher than 3-month VIX. And we're barely even inverted today. We're just hanging out, spent most of the year below zeros, which is kind of very curiously absent. And I wonder if this is kind of going in with those lows, maybe breaking 36 is something that causes this to finally spike. We finally get a big VIX curve inversion. And that's that real fear. That was a big thing that everybody was looking for kind of back in May, was everybody was looking for capitulation. Now that story has kind of gone by the wayside, and we kind of seem to be experiencing some real fear this week.
Yeah, I mean, on the topic of sentiment, one of the big topics of discussion this week was the fact that we saw the 5th highest reading in the percentage of bearish respondents in the AAII sentiment survey. And there was a lot of discussion about that. You're saying we haven't seen capitulation yet. Some of these surveys are saying, extreme levels of bearishness. But there's a conversation among technicians right now, kind of among the validity of that data. Are market participants truly as bearish as those surveys suggest? You can say you're bearish, but does that mean you've reduced your exposure or acted on that bearishness yet? A little questionable. So what is kind of your read there when you see surveys like that?
Yeah, I think there's a lot of different data points you can look at. You can look at things like the VIX. You can look at ETF flows. You can even just really ask people what what are you actually doing with your money? I think it's the old Walter Deemer quote. It's not when everybody says they're bearish that the market bottoms. It's when they're finished selling. And I think if you talk to people, you just really don't get the sense that people have given up and actually liquidated the equities. I think I actually saw a cool chart that the AAII asset allocation part of the survey, not what do you think is going to happen in the next 6 months, but like how much cash are you holding, is still significantly below the levels that we saw in 2008. So there's a lot of different data points, but I do tend to agree that the overall weight of the evidence suggests that maybe people haven't acted as bearishly as they might feel or might be saying they feel about the market in the next 6 months.
Yeah, another development I kind of want to get your take on here is seasonality, right? I've been calling it the eye of the storm that we're in terms of seasonality. And by that, I mean, we're in the worst month of the year, September. And a lot of that September weakness occurs at the end of the month. Pretty much those last few days of September that we're approaching right now, How do you think about seasonality here?
I mean, I definitely pay attention to it. We had this in our Beat the Bench Monday morning playbook on Monday, and we're kind of right in the thick of the worst 2 weeks. As you mentioned, the very end of September is one of the very worst stretches of the calendar. The good news is things get really, really bullish right after this. I mean, you look at the line chart version of this, and this is basically the bottom for the year on an average basis. And so things don't always work out perfectly, but there's really a kind of very textbook scenario where this is like the classic retest. Maybe we are correct that most stocks bottomed. We're getting the panic. We're in the worst seasonal part. And then a lot of things kind of line up for a bullish end of the year. Now, I don't think a bullish end of the year is getting us, anywhere back to where we started or anything like that. And you could almost even say that, you could have a couple month rally and we'd still be in a bear market. But I think things do kind of line up pretty well. If you're looking at the internals, you're looking at the retest, and you're looking at seasonality is really bad for a few more days, but then it gets really, really bullish. We also have a lot of panic. We're starting to register those oversold signals. So I don't think it's the time to just be, panicking. We're looking for other people to panic, but I don't think that's what we want to do right now. We still probably want to be playing defense. Hopefully you have been already, but I think it's okay to be thinking about the long side more so than at any point so far this year.
Yeah, I forget who said it, but sometime this week I heard someone say, in terms of seasonality, this is either the best time or the worst time to be buying. In just looking at the seasonal patterns, and by that, you mentioned it. I think towards mid-October, the calendar flips bullish, and then Q4 has historically been the best quarter for the S&P 500. And I think in both midterm election years and just overall, that Q4 tends to be the strongest, right?
Yeah, I mean, Q4 strong, and one of my favorite stats, around this time of the year is that midterm elections, you go back to like 1950, and we got a decent number of data points actually. Midterm elections, 12 months from the date of the midterm election, we've never been lower. So if your time horizon is 1 year, we're already, down this much. We've already seen this much shaping up. If you're willing to be that patient, 1 year out, I think it does start to get pretty hard to bet on the market, against the market from these levels.
Yeah, so let's move on to another big development this week, that what I've been calling the wrecking balls, and that of course is the dollar and yields. Let's start off with yields. They broke out to their highest level since 2010, and it's really just been nonstop, and they've really accelerated to the upside in the past week or so. So what are you thinking as far as yields here and the implications it could have on stocks?
Yeah, I mean, you're right. It's a wrecking ball. It's wrecking 60-40 portfolios, but it kind of seems to be what's directly causing the equity market stress, which is just in such contrast to the diversification and things like that of stocks versus bonds that I think people have had pounded into their heads for the past 30 to 40 years. But the fact is, if you just take a step back, and this is the chart of the 30-year Treasury yield, this was a very textbook inverse head and shoulders pattern that kind of followed a blow off bottom. And once we broke out about 2.5%, the target was 4%. I mean, there's just a clean measure there of 150 basis points from the head to the neckline. And that 4% also kind of lines up with those 2013 to 2014 highs. So really, since we broke out in late March, that's kind of been what I've been looking for. Looked a little bit crazy then, seems a little bit more realistic now, but it's just hard to see how this trend. I think there's going to be a time to buy bonds eventually. I don't think just because we declined for 40 years that we're going to go up for 40 years, but I don't think the time to buy bonds is now.
Yeah, so let's move on to the other wrecking ball, the dollar, right? I had John Roque on the show when I first had him on a few months ago. He said he thought that the dollar index was headed to 120, and I couldn't believe it. I mean, that sounded like a very aggressive price target at the time, but here we are at 112, and that doesn't seem so unrealistic anymore, does it?
No, I mean, you just look at the chart, it's just kind of blue skies up into those highs. And even that rectangle pattern, we don't have the bottom of it marked there, but you go from 90 to about 104 with the breakout point and tack that on to the breakout point. And it also puts you right up there at 120. So I tend to agree. If we make it there, that's probably a pretty ugly situation, or maybe it's a central bank intervening and the Fed finally kind of realizing that they're breaking things if we actually get there. But the chart says it's just a runaway train at this point, and that's not good for gold. It's not good for cryptocurrencies. It's not good for bonds. It's not good for stocks. Not good for international equities. It really has been the only thing working this year, big picture.
Yeah, I mean, my question for you was really, do you think we could get to 120 before we retest 103? Like, do we kind of have to retest that base? Because it's just been such a relentless uptrend. I mean, I've given up trying to call a top in this thing. You've had these negative divergences and it just continues to just rip higher and higher. So what do you think? Do you think it hits 120 before seeing 103 or what? And of course, there's no right answer, but yeah.
Right. So I'm with you. You can see I brought the chart and I keep 14-period RSI on my screen. And, there's been multiple times this year where like, oh, we're right at the high, big time negative bearish divergence. Maybe this is the time we can, finally turn this trend. And every time it powers right through. It's been roughly riding the 50-day moving average the whole way up. And so for me at this point, it's really hard to see how we retest. And you just kind of look at the macro picture. Maybe it's buying in a little bit to the panic, but it just seems like this is just going to keep on going until something happens. So it's hard for me to see just a classic pullback or retest at this point.
Yeah, I mean, it does feel like a crowded trade, but then you look at what's in the dollar index, right? You look at the euro, and that chart looks terrible. I mean, that thing looks like it's going much lower, right? So, and the yen as well. What's your thoughts on those?
Yeah, I mean, the euro, everybody likes to talk about parity, but really once it broke 1.03, of course, it's 58 to 60% of the DXY. So it looks like the inverse of it. And it's just, there's really no support. And if you look at kind of what they've pieced together for the euro history pre-euro from the other currencies, you broke an uptrend line that goes back to the 80s, but it looks like it could go to 0.85 there. And so there's really no support. It tells you to just sell every rally that you got in the euro. The yen is a similar story. Now they've got such a unique problem. It's not the energy crisis. It's just the fact that their central bank has decided that they are going to keep their 10-year treasury yields or those 10-year government bond yields at 25 basis points, no matter what. And that has come at a huge cost to the currency. We are up into a big kind of point where maybe this is, if you actually had a short yen trade on, maybe this is where you take a little bit of profits or something like that. But it similarly feels like a runaway train. And as long as interest rates are going higher and the Fed is still, being hawkish and the Bank of Japan is determined not to be, I don't see how this dynamic changes. And the last thing I'd say just on the dollar, overall, everybody's aware of the dollar. Everybody's aware of the effect that it's having right now. But if you look at the COT data, it really isn't nearly as extreme. There's a lot of net longs for sure, but it really isn't as extreme as you saw at some of the prior peaks over the past decade. So there might actually be room for more people to hop on that trade before it's time for us to jump off.
That's interesting because I think Bank of America had their fund manager survey this week, and they labeled the dollar one of the most crowded trades. You'll have to double check me on that, but I'm pretty sure I saw that. But you're saying if you look at the positioning data, you're not seeing it at a historical extreme.
Yeah, I mean, that's with the COT data, but the Bank of America Global Fund Manager is kind of a fun one. People will say like, this is the biggest risk, or this is what I'm worried about, and then it's like, what are you doing? And they often aren't, all those people aren't completely long the dollar in their portfolios, or they might own international stocks or whatever it is. So sometimes you get some quirks in there, and I think it goes back to what are you saying versus what are you doing. both are important to look at, but I always tend to side a little bit more, give a little bit more weight to what are people actually doing with the money and who's betting on it.
Right. So I want to move on to commodities next. We shared this chart for chart of the day. It's a chart of yours of the commodity ETF DBC. And you had pointed out a couple weeks ago that DBC was breaking its 200-day moving average for the first time in nearly 2 years. And here we are today, we get a fresh low in commodities. So what are you thinking here? Do you think that commodity super cycle that we were all talking about a few months ago is off the table now?
Short term, yeah. There's really not anything, for my time horizon looking out over the next couple of weeks and months. There's nothing that gets me super excited. It still has relative strength versus both stocks and bonds, just from kind of topping out in June as opposed to the turn of the year or prior. But you're right, taking out the 200-day moving average, taking out those lows, and even though it is a diversified commodity ETF, it really tilts heavily towards the energy commodities. And here on the screen, we've got oil losing a major level down there at about the 85, 86 range. This just looks like something that's completely turned in a really very textbook way, where you had the blow off top back in March. You made another attempt at it a few months later with a big time bearish momentum divergence. And now the trend is just kind of slowly turning over on itself. And so if energy, you also look at nat gas, which has been unable to punch back through its June highs. If those aren't going higher, DBC is just simply not going to go higher. And it's frankly not like the rest of that space has been doing incredibly well prior to the energy commodities. Gold's done nothing. Copper's a big top. So it's hard to be bullish on commodities broadly, except maybe in relative terms versus stocks or bonds. And even that trade certainly isn't working out today.
Yeah, I mean, it really has been the only positive asset class really to hide out in this year. And what you're saying is we could maybe see that relationship kind of mean revert a little bit, or maybe that disparity between the returns come in a little bit.
Yeah, I think so. And we kind of saw this in 2008, whether you look at oil or whether you look at just the energy sector specifically. The S&P 500 topped in October of 2007, but energy didn't top until May of 2008. So you had this multi-month period where energy was exhibiting a lot of relative strength, and then it just collapsed. And so, every cycle is a little bit different. But I've kind of had that in the back of my mind. And now that it's kind of playing out, it doesn't look like energy is really going to be a place to hide out anymore, if you're asking me.
Yeah, we've really seen the air come out of that energy trade in the past few weeks. And I'm sure you've heard the phrase before, in bear markets, they come for them all. And that's kind of what we're seeing in terms of energy right now, right?
Yeah, there's a lot of those fun ones. I think they come from pretty girls last. When they raid the bar, even the piano player goes to jail. Whatever it is, nobody's spared from a real bear market, and I don't think anybody would argue that we are very much in a real bear market today.
So Scott, let's finish up with crypto. It continues to amaze me how well Bitcoin, or how closely Bitcoin and stocks have been moving together this year. It's in a lot of ways been a great leading indicator, especially on weekends. You can kind of see, okay, did Bitcoin totally dump this weekend, or did it hold some support levels, and can kind of give you an indication for how stocks might open. And it's nice to have it kind of as a confirmation tool to confirm what you're seeing in stocks too, as long as that correlation exists. So go ahead.
Oh, I was just going to say, I completely agree. I work with, and a lot of my subscribers and followers are financial advisors. They're not probably buying Bitcoin or Ethereum in Coinbase accounts or anything like that for clients. But you're right. It acts just like a very high beta Nasdaq stock, leading indicator, super volatile. So I think it's something that people should be paying attention to, even if they aren't going to be actually buying Bitcoin or Ethereum.
Yeah, I mean, it's hanging in there right at those prior cycle highs, from 2017, right around 19,000. And we've been kind of whipsawing around that level for a couple months now, but it is holding. But if some of those things like the dollar moving higher or yields, if those continue to play out and they continue to move higher, I don't think we're going to see that support level hold. What do you think?
No, yeah, support, tends to mean a whole lot less when you're in a clear downtrend like this. My target for Bitcoin is about 11,000. You can kind of see that big wedge triangle that we had from about 2018 to 2020. That's roughly the breakout point where the huge rally started. And I frankly think that's where Bitcoin is going back to. I just think this trend is too bad, and the liquidity aspect of this, and I think that's why it feeds into the correlation with stocks and things like that. It's just a pure liquidity thing. We do not have an environment that is good for assets that require liquidity and that kind of speculative fever. I just think it has more downside to go. I really don't think that support from the 2018 highs or so is going to hold.
Yeah, well, Scott, I could sit here and rip through charts with you all weekend, but we should probably wrap it up. But before you go, I want to ask you about this new venture you've started, Beat the Bench. Is that what it's called, right?
Yeah, it's Beat the Bench. What I do is investment strategy for investment advisors, and Beat the Bench is on Substack, so you can find it on there. You can find it on their mobile-friendly app, or sign up and get subscribed. We have both free and paid content, but really what we're targeting is financial advisors. We do 3 posts every single week. We have a Monday morning playbook. We do a deep dive into an important story and really show all the different angles to the technical charts. And then we do individual equity reports, which our latest was just released on Thursday. So this is actually our first full week doing all 3 of those publications. So if you'd like to subscribe, beatthebench.substack.com. You can see all the material that we have on there. Everything is completely free this week. So hopefully people check it out.
Yeah, and I've been really enjoying all the notes that you've been putting out so far. You put out a great one yesterday called The Good, the Bad, and the Ugly. And you went through each of the 11 sectors of the S&P 500, and you highlighted a good, a bad, and an ugly stock in each of those sectors. So not only is it interesting and insightful, it's very creative too. And we wish you the best of luck with it.
Thanks, man. It was a little bit tough to find some good charts in this market, but I think doing that work even kind of helps tell you what's really going on under the surface. But I appreciate those words, and I appreciate the chart report featuring it.
Oh yeah, of course. Well, Scott, thank you again for coming on, and I hope you have a great weekend. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.